Matthew. Look, thanks for having us on. My name's Stephen Twyerould. I'm the president and CEO of Gunnison Copper. And we've got some exciting news because we're going to be producing copper, like a new mine in Arizona, next month.
Well, that's refreshing for a junior mining company, producing and making money, hopefully as well. Stephen, it might be worth you sort of introducing yourself to people, give them a little bit on your background and your sort of track record up until now.
Look, I've been a geologist my whole life, right? Grew up in Australia in the mining industry. Started underground in Kalgoorlie 40 years ago, something like that. But been working on this project in Arizona here for at least 10 years. There's kind of like two projects we have at our whole mining camp that we control. One is called the Gunnison Copper Open Pit. The other is Johnson Camp. So, for those of you who don't know, we did start Gunnison as an in-situ mine, started that in 2020. Had a lot of technical challenges. I mean, the management team did a great job raising money for that. We actually brought that into production. COVID was a problem in 2020, as we all know, and supply chain. So we had some challenges there. And then, during that 4-year period or so after 2020, when we were sorting that out, copper price goes up. We realized that if you're doing an open pit, you're going to get 20 to 30% more copper out of the ground than in situ recovery. That 20 to 30% at, $4 copper makes a huge difference. So we switched the mine plan to open pit. We did that right at the end of 2024. So our whole focus right now is that big Gunnison open pit, and that's our long-term project. And we're going to move that into pre-feas next year. But the whole time we were sort of working on that, we partnered with Nuton LLC, which is a Rio Tinto venture company. And we are constructing like the first ever sulfide leach mine using Nuton technology and copper production, in September. So excited about it.
Okay, so we've kind of got a production component, a near-term production component, more importantly, and then a sort of, I guess, a bigger open pit heap leach, presumably, project as well. So let's start with what you seem to be excited about is obviously getting into production, U.S. copper for the U.S. So tell us about the Johnson camp. What exactly? How long have you had that asset, and how come you're so close to construction?
We partnered with Nuton LLC. So a lot of you know about that. That's so they're using their sulfide leaching technology. The good thing about that is that they're providing the finance for the whole mine construction. You can think of it like a sort of, zero interest, zero liability debt, if you like. Spent over $100 million, or rather Nuton has spent over $100 million. Our management team, the 100% operators, we're the 100% owners and 100% managers of the project. So although Nuton is providing the funding and the technology and a lot of advice, we're the ones actually building it. And so, we started construction back in May last year, and what's it taken us? Probably less than 18 months to be in a position where we're going to be producing our copper cathode in September, and supplying the US domestic market, which is kind of like what the whole story is in the US right now. Very excited about that.
Okay, so amazing what you can do with money, right? So, and especially when it's not yours. So Nuton is Rio Tinto technology, right? And so they've got money to spare. What they've given you all of the upside though. So what's in it for them? Why are they doing it?
They haven't given us all the upside. The way that the transaction works is this is like a 4 or 5 year initial mine plan. At the end of that 4 or 5 years, they can choose to joint venture with us as a minority partner at 49%, or they can license the technology to us and we just keep mining the rest of the mine life, which is, perhaps 15 years or so. So during this period of that first 5 years, the copper that we produce using sulfide and oxide ore goes toward paying down their investment. So, they're sitting there thinking, you know what, we invest all this money, and if we can pay this down in 4 years, then it's a free ride, it's a free test for them. And for them to go and recreate this elsewhere, because we already had the solvent extraction electrowinning plant, we already had the permits, we just needed to amend them, we've already got the management team, and we've got an open pit sitting there with sulfide in the bottom of it. So it was kind of like a real sweet spot for them, because they could get moving very quickly without having to kind of build an SXEW, permit from scratch, start a mine from scratch. It's already there. It's worked out really well. And they're a great team to work with.
What's the financial benefit to you in the short term and the longer term, should they decide to, or you both decide to go ahead with each other?
In the short term?
Yeah.
Obviously, we've been able to, beef up our entire operating and management team. So now we've got, metallurgists, engineers, geologists, and everything. And that means that our kind of knowledge base is really superior now to most junior companies, where they're lucky to have one geologist on staff. We don't pay for that. So it's a massive benefit. If we can if this goes well, and we can pay down that investment that Nuton's made quickly, we actually get 100% of the net operating profit after that.
Okay.
So it's really about how quickly can we pay this down. If we pay it down in 3 years, we're going to see positive cash flow into the company's coffers. If it takes us 4 years, maybe a little bit, if we don't pay it down, it doesn't matter. It gets written off back to zero, and then we launch the joint venture after that. The strategic advantage is there's not going to be another junior company that knows more about sulfide leaching than what we do. Because we get to turn the knobs. They're paying the money and they're advising us on which knob to turn, but we get to turn the knobs. We manage and operate that. So, that provides some leverage, certainly in the market, but also in our other assets, because Gunnison, the big open pit, has some sulfide in it. And we'd like to be able to demonstrate we can leach that as well.
Okay. So the Johnson Camp component, zero risk to you, zero financial exposure to you, all the upside in terms of the learning and potential partnership with obviously Rio and Nuton, and then down the line with Gunnison project, be able to apply that technology which you've learned about. Okay, got it. So are you guiding any kind of financial upside on the Nuton project pre joint venture?
No, we're not.
No. Okay, that's fine. It's all upside. It's free ride, right? Okay, and then the joint venture would be just specifically on would it be both projects presumably?
Just Johnson Camp.
Just Johnson Camp. Okay, that's good. Fantastic. Okay, and what else do I need to know about Johnson Camp in terms of size and potential and expansion?
Yeah, its capacity is 25 million pound per annum. So it's not a gigantic plant. We're not sort of trying to compete with with Freeport in the state and Morenci, but it's a solid production, 25 million pound per annum capacity. We hope to reach that capacity around mid next year. I think it's important to know that there's two process streams at Johnson Camp. One of them's oxide, and that's just real simple stuff. So you're going to generate revenue from that, kind of no matter what, it's your base load. The other one is the sulfide, and that's kind of the swing component. So we don't expect to have both streams up to capacity until probably June next year.
Right, and would the joint venture look to expand the Johnson Camp mine in terms of exploration budgets, or is this purely about the science and understanding the technology?
There's capacity to expand the mine.
Right.
like there's a solid resource that goes beyond the 5 years. Like initially, we had a plan for about 20-year mine life, and we just took the first 5 years and wrapped it into this Nuton agreement. If it all works out, we've got another 10 or 15 years in front of us, and that can generate a solid cash flow for the company, help fund the development of our other projects.
Right. Okay. And given, like, I think I've only heard of a handful or so of companies that are involved in this kind of Nuton type relationship with Rio Tinto. How have you got any sense of what the economics on around the licensing would look like, or is it a bit early for them to?
Bit early for them to do that.
Bit early. Okay. Fine. Can we talk about Gunnison and what you're hoping to? Well, actually, no. Before I do, you talk about being in production. When?
In September.
September. That's not too far away.
September.
Right.
Yeah.
And what do you? Is this just a sort of just like showing we've got the technology, it works? But what's the kind of ramp up look like?
So the ramp up, like I said, is probably not going to ramp up until June, July 26. You know, people ask me all the time, like when will you know how well Nuton works? They ask me that all the time. And honestly, I think it's like 4 years from now. You're not going to know immediately because there's going to be optimization. This is the first time it's been done at scale. So it's going to start ramping up, and then we're constantly going to be working out how to optimize this. They're going to be working out how to optimize this by changing some of the components until they get into the groove, and then it should be in sort of, optimized production. So I don't think you're going to know until 4 or 5 years just exactly how well, but all of the test work looks fantastic. I mean, it really does.
Right, and who's selling this copper cathode to, and so what sort of quantities realistically this year and next?
Yeah, so we're selling the cathode through Rio Tinto, right? So essentially, they're our offtake agent.
Right. Okay.
And at this point, they're selling that cathode domestically in the US, which is what we want. So we're a domestic producer, and we supply the product directly into US markets. Okay,
and you've got the OTCQB listing. Presumably, if this works out, you'll be ramping up to OTCQX, presumably. Is that the idea?
Yes.
Okay. Okay, fantastic. And obviously, you make mention, obviously, not only Rio Tinto, but also Department of Energy. What's their involvement?
Say again? Nothing.
You in your marketing, you talk about the Department of Energy, U.S. Department of Energy as well. What's their involvement in this?
Right. Yeah, last year we applied for what was called a 48C tax credit with the Department of Energy. We were to my knowledge, we were the only copper project in the US that was granted one of these 48C tax credits, 13.9 million US. It's the way these tax credits work is that you can sell them on the market. They're a fully transferable credit. So you can sell that credit for cash because obviously, we're not going to be making, we're going to be paying taxes not for a number of years. So the best way for us to realize this credit is to sell that credit. There's a certification process that we're going through right now. We hope to have that certification finished sometime around sort of late September, October, and then we'll go out to market and sell that credit. We'll be successful at that. Just exactly whether you won't realize the whole 13.9 million, right? Whoever buys it's going to want a discount on that. Maybe it's sort of 92% we'll get or something like that, and then that's just a whole bunch of sort of non-dilutive cash that we can bring into the organization later this year.
Okay, interesting. Okay, so you kind of got a kind of proof of concept around the technology with Nuton. We've explained the relationship and financial and otherwise, and the timing. So understood. But I guess the big prize that you seem to be intimating is obviously if you can take that technology and apply that to the Gunnison open pit project. So let's start with, well, what have you got? What does the Gunnison open pit look like?
Looks like a really big pit, at least at a PEA.
Give me numbers though.
at least at a PEA level right now. So the PEA, we released that late last year. NPV after tax US dollars about 1.3 billion. And we used around a $4.10 copper price for that. So pretty impressive. Like, our market cap today in US, I don't know, it's probably somewhere between 70 million. There you go. $1.3 billion NPV. If we can move that into PFS and then feasibility and realize that value, then there's huge upside on the stock and the market cap of the company. Internal rate of returns around 20%, paybacks around 4 years. The production rate on that asset is around 170 million pounds of copper per annum for around 18 years. So it's a significant production profile. And the all-in sustaining cash cost about $1.94. So, with $4 copper, we're in front by $2 a pound. And 170 million pound a year, that's a lot of cash flow. So it's just designed as one large open pit and then waste stockpile. About 90% or so of the production is coming from oxide material. So I know I did talk about Nuton and sulfide. It's not driving the economics. We're not relying on that technology for the Gunnison pit. It's well and truly paid for by the sulfide, a long time before, the oxide rather, a long time before that. So it looks really impressive, competitive against our peers. What we're doing right now, that PEA that we did at the end of last year identified a number of opportunities. And so we called those opportunities the High Value Add Program. We just gave them a moniker, HVA. They are to do with sort of non-traditional byproducts. So as we mine this pit, we have gravel that comes off as a waste byproduct. And we're paying for the gravel. That's like part of the strip, part of the pre-strip and part of the strip. So we dig this gravel up and we put it on a waste stockpile and we assume zero value for it. Well, gravel's a hot commodity in a lot of places. Making that sort of, finding a market for that is important. And we have the Union Pacific rail line about 3 kilometers to the south of us. So, our model has us putting in a rail spur. It's about a 4 kilometer long rail spur. And then that opens up markets for that gravel. So part of the program we're working on right now is we did some drilling in the gravel. We took a lot of samples. There's some experts who are analyzing that to try and tell us what it's worth. That's just going to add. There's no subtract because they're already paying for it in the current model with no revenue. There's another non-traditional byproduct, and that's limestone. So in the hanging wall of a deposit, there's kind of 85 plus million tons of this white marble, white limestone. It looks like the same stuff you put on your kitchen counter, right? It's really nice looking stuff. Drilled, blast and stockpiled as waste, and we're assuming zero value for it. So we think there's a huge market for that as well. Niche products as well as in the construction industry, cement manufacturing. So those two programs are happening right now, and we'd like to get the results from them later this year and wrap them up to an updated PEA at the end of this year ahead of launching the PFS next year.
Okay, so what I'm hearing about Gunnison is it's conventional mining on the whole, bar 10% potentially open to this Nuton technology. So you're not reliant on that per se. Okay, and in terms of funding for the updated PEA and then getting into the PFS, where are you with that?
Yeah, we've
got
in
money?
good shape. Yeah, we raised Canadian 14 million this year on 2 separate financings. Most of the HVA was kind of paid for already. with that financing, we just expanded some of the HVA program to add a few more components to it. And it allows us to start working on the PFS now. So we're starting to put information and teams together and do our planning, and starting to sort of progress the early stage PFS stuff. And then the rest of that funding will roll into next year to start the PFS off.
Okay. Can I just ask about, you obviously you talked about the gravel byproduct there. In terms of the NPV8 of, where would you say 1.3 billion, was it? Okay.
Yes. Yeah.
Something like that, right? How much of that was put down against the gravel byproduct?
Zero.
Zero. Amazing. Okay, fantastic. So, and in terms of the updated PEA, will you be putting something in there, or do you need to kind of work out what the realistic, realizable, or addressable market is?
Yeah, we'd like to put that in there this time, right?
Okay.
But what we need, we need the market studies. So, if I go back to square one, we need people who know aggregate and gravel to look at the core and analyze it. That's what they're doing right now. Then they need to do a market study, and then they need to tell us how much of this can we sell. Maybe we can only sell 5% of it. I don't know, right? But there's a number. And that's an exact same model for the limestone. So
Right,
they're
okay,
sampling
makes
it,
sense.
they're doing it. Right now, there's zero value in the model. Even if we sell 5% of the gravel and maybe, 30, 40% of the limestone, it just goes straight to the bottom line in revenue, because we already paid the cost of digging it up. It's already in the cost base for the NPV. So we figure they're only upside on those two.
Okay. Well, let's come back to that. There's nothing to be said about that at the moment. Let's talk about some of the other kind of economic enhancers, such as mineralized mineral sorting. How are you getting on with that?
I'm actually in Kentucky right now at the mineral sorting lab.
Okay.
So we've done like one sort of test run. We're doing another one right now. We've got another one coming up at the end of September, early October. The concept of it is really simple. It's not in the current PEA. There's zero value for it in that 1.3. We believe in the Martin Formation. Like, some of our rocks consume more acid than a typical open pit. It's just a fact. We believe we can remove close to 40 or 50% of the material that we're processing as waste before we spend the money on acid on it. So we mine it all, we sort it, good stuff goes on the leach pad, bad stuff goes to the waste pile. If we can pull 40% of that material out of the Martin Formation, then our acid consumption is going to go down by a factor of 2 or 3, and our grade on that material will go up. Our capital costs will come down because we don't need such a big leach pad. There's other capital costs will come down because the acid plant that we need won't be as big. So there's a lot of upside. It's a technology thing though, and so we don't want to rely on that technology. It's really about, if this work, how much more value can it add to what we already have today?
Yeah. Okay. And so, just listening to the story, like you've got to a good place, and obviously moving Gunnison along the economic study curve is essential, and it sounds to be going well. What are the things that you're kind of pointing up over and above, gravel and limestone byproduct and maybe sorting? What are the things that you're kind of honing the team on and saying, look, if we can get this right, we might be able to save some money, make some money?
Absolutely. Yeah, because we actually, you've spelled out our game plan or our strategy. We want to reduce the initial capital on the pit, and we want to increase the revenue, and we want to decrease the cost. Everybody wants to do that, right? The thing is that because we move a lot of gravel, because this Gunnison ore body has got, a couple of 100 meters or less of gravel on top. That's a pre-strip, costs a lot of money. Right now, we're doing traditional sort of excavation and truck haul. So we've got a team looking at, do we have to drill and blast this stuff? We have some drill and blast costs in there. So our geotechnical team are telling us, no, based on the strengths test, we can rip this stuff. It's free dig. And then the rest of the team are saying, let's look at a conveyor or a railveyor, because just moving trucks back and forth, right? There's got to be a better way. So the technical team are really looking at, can we get that initial capital cost down? We're also looking at ways we can sort of manage the acid plant. Like, this works really well if you build your own acid plant. We think it's a strategic advantage of our project because we're on the rail line. We can just rail in molten sulfur from Texas or California, make acid on site. That means our acid costs are lower than our peers, but it also reduces the risk on imported acid. Most of the acid coming into Arizona comes from Mexico, the stuff that's for sale. So, there's a concern about the security of that going forward. And there's, there's sort of 3 or 4 development projects in Arizona besides us. So there's potential to see the acid market come under stress. So we want to de-risk that by building our own acid plant, and that's in the plan. So we're just looking at ways we can get the capital cost of the acid plant down as well.
Okay.
There's other things we can do. Yeah.
Yeah. What about like the leach kinetics there? I mean, I think I probably said it, not you. It's relatively simple. This is really simple technically. It seems. But what else are you looking at?
Looking at sort of crushing the different sizes right now.
Okay. Yeah.
I think we're looking at a lot of the material was either run of mine or maybe a plus 6 inch. What is it going to cost us to crush to 4 inch or 2 inch? And what's the cost benefit of that? Because your recovery rate goes up and the kinetics go up. You get not just more copper, but you get it a lot faster.
Mm.
So we're looking at that. We're also looking at, like, we have this whole mining camp, and to the north of us, it's only several kilometers, is a deposit called Strom Harris. We don't highlight it that much because it's kind of small, but it's good grade. It's like 0.5% copper equivalent. So we're just looking at, like, would that make a good starter pit? Strip ratio might be a little less. We might be able to get actually revenue from that a year sooner if we start on that pit. And then we bring Gunnison in parallel, but then start to ramp that up. What does that look like in a model? So there's a lot of that sort of thing going on.
Okay. What about permitting pathways, etc.? Where are you with that? Because obviously ISR was very different from what you're doing now. So it's a lot easier?
It's a lot easier, absolutely a lot easier. The neat thing is that it's the same permit, but the same state permits, we just have to amend them. So we don't go back to square one. So to give you an example, like the ISR, the in situ, permitted a PLS pond and a raffinate pond and several other ponds, but we still need the same ponds, right? All we're doing is replacing the in situ with an open pit. So it's a major amendment. It's a public process, but you're not starting from scratch. We have the data, we have the information. We've also been very successful at permitting. So, for example, at Johnson Camp, that's in production, we amended our air permit, we amended our mine reclamation plan, and we amended our aquifer protection permit. All of them took less than 12 months. And they, that's public comment, they're full amendments. So, we've permitted 2 mines to full operational level in the last 5 years. That includes the in situ. So, permitting is always a challenge, and you've got to be cautious about how you go about running the permitting process. It's really important to bring in the stakeholders around you. It's really important to consult with the communities and everybody. You do that properly, and follow the rules and regulations, then you can permit these projects fairly quickly. Okay. Which we've been able to.
Okay. I'm going to come back to you another time on when you know a little bit more about the kind of because I guess the sensitivities around haulage, distance, and strip ratios and waste classifications around the kind of gravel and the limestone would be interesting to kind of get into. So another time. I mean, it's kind of strikes me. What's going on in my head here is it kind of feels like the few companies that were able to do this. I think the last 5 years have been very, very difficult, and I think the name of the game has been just stay in the game. Just stay around long enough to kind of get through a cycle. And the Nuton deal for you kind of put money in the pocket, gave you guys something to focus on, which has maybe not a near-term economic benefit, but it definitely does intellectually. But it may be, in 4 or 5 years' time when if you kind of move things on at Johnson Camp. But where you want to have Gunnison is really, it's like, so, and we'll work out what the economics are in terms of what the licensing costs you and, what you're left with after that. But Gunnison seems the thing that you've really kind of moved forward and simplified. And I think that's where the kind of main bit of the prize is. So do you think being a kind of US asset with a US focus in terms of marketing, it differentiates you from some of the kind of copper plays that are out there at the moment? I mean, you're TSX, I know OTC, and I think you're also on the Frankfurt, aren't you? There's not a lot of players out there at the moment. Does that help the whole US component?
Totally helps. I mean, there's so much positive buzz in the US. It's all about US copper. It's all about domestic copper. We're right in the middle of it. Like, all the management lives in Arizona. All our operations are in Arizona. Arizona's like the premier copper state in the US. So much positive buzz. And, it's not just the positive buzz. Like, we've had the Department of Energy reach out to us again. We've had the Department of Defense reach out to us. There's so many opportunities there, particularly if you can deliver quickly, like what we hope to do with our projects.
Well, I think that's, I can back you up on that and validate that, because I think in things like uranium and critical minerals, like and rare earths, we are definitely seeing a lot less talking from politicians, a lot more doing. Grants seem available, loan guarantees available, offtake agreements are there. Just ask MP Materials. So you're right at the epicenter. It's interesting times indeed. Does that mean that you have to have like people, who are full time on that kind of interaction with US departments, or are they literally knocking at the door?
We get inbound from them, unsolicited inbound from them, which has never happened before. So that's exciting, right? That said, like we already had started to develop a relationship with them from even from the in situ days, because back then under the Biden administration, it was all about the not just critical minerals but sort of this clean energy transition as well, and the in situ project had that sort of much lower environmental footprint. So we had a lot of contacts there. Those contacts reached out to us unsolicited, and come back and said, well, look, you're not doing the in situ, but you're doing the open pit now. Tell us about that. When, what's your time frame? What do you need? So those conversations have started. We haven't, we haven't engaged like lobbyists to go to Washington and bang on doors and talk to people. That is a successful pathway. People do that very successfully. We haven't done that as yet because we haven't needed to. Would we look at that in the future? Absolutely. We have a gentleman on our board, Fred Duval. So really, really nice guy, long-term Arizona family. Fred ran for governor in Arizona as a Democrat against Governor Ducey at the time. Fred is extremely well connected at the state and federal level. And so, he's been really useful. He's a chairman of the board. You want to talk to somebody in Washington, we just say, Fred, who should we be talking to? And, he'll give us a name and a number.
Yeah, no. Mr. With Al Gore, didn't he?
Yeah.
There's a name.
He's great.
There's a name. Okay, so you look at really kind of positive kind of financing environment at the moment, very positive for critical minerals, and especially those that can show route to market as quickly as you are talking about, or hopefully demonstrating in September. You have talked publicly about maybe using or looking to kind of refinance the debt component at some point next year. Is it a case of wait and see what the market brings and how the market reacts to this production profile that you're going to be putting out there?
We have a strategy on that. We want to use that 48C money to retire as much of that debt as we can, non-dilutive, sort of. So we've earmarked as much of that as we can towards that debt. The remainder of the debt, the Nabari team, have agreed to run a process to refinance that and push the debt out. Our goal is to just get rid of it completely if we can. And if there's any left, it's going to be small. So we think we can manage that and get it off the books, if not this year, sort of end of Q1 next year is our goal. So it's gone.
Okay, so there's no restrictions on the 48C tax credit, no? You can use that how you wish.
There's some restrictions on it, like in all fairness, the 48C is really around Johnson Camp and Nuton. So they're going to take about 3 million of the 48C. And then we also expect that we're not going to get the whole 13.9. You take 3 off, it leaves 10.9. There's a cost with the whole process, with certification, etc. We hope to realize around 8 million of that in our pocket. We'll use that 8 million to retire that debt, or a big portion of it. So if we did, for example, use the whole 8 million, there'd be something like 13 million total. So there's about 5 million left. That's manageable.
Okay. And you raised this money as well earlier when was that? That was July, wasn't it? Back in July, June, July.
Yeah, the last one was in July. Yeah.
Yeah. Okay. So 8.6 million as well. So you kind of puts the balance sheet in a good place at the moment. And just talking of money. So on the Nuton project, how does that work? Obviously, your guys turn the knobs. You're paid a management fee in there. What's that? How do they work that number out there? What cost does that cover for you?
The way it works is we work very closely with Nuton. There's a technical committee, there's a management committee. We agree the budget, the costs, the forecasts. Once we've agreed that as a team, they prepay each quarter.
Okay.
So if we're going to spend 50 million next quarter, we put in a cash call. They write a check for the 50 million at the start of the quarter. We track and manage how we're spending that against the targets and the goals that are in the forecast and the budget. So long as we keep delivering on them, they keep, supplying the money. And that includes operating and capital costs at present. Yeah.
Okay. And given what you've done at the Johnson camp, is the mentality the same with Gunnison in the sense that you've got a project which is big enough now to kind of get going on at Gunnison potentially, if on the economic study phase, will you be spending money on drilling it to show to people it's bigger, it can be bigger? Because I don't know what the end game here is. Is it to make it pretty for someone else to build, or is it to actually do what you've done with Johnson and say, let's get into some kind of revenue profile?
Gunnison, to be frank, is probably too big for us to develop on our own. We need a partner. It's really a matter of when do you bring that partner in that creates the most value for the shareholders? It's not now, right? So if we can get the value up, if we could deliver, for example, a PFS and a fully permitted project, open pit at the same time, because we want to run permitting and PFS in 2026, that's a massively valuable asset. Fully permitted, got a PFS done, risks, diminished. That's a great time to bring a partner in or do some sort of strategic transaction that benefits all the shareholders. And that's our goal.
Okay, so that could be a mix of anything, offload the whole lot, get carried for I don't know, whatever, 30% sort of number. To be decided. Okay, so that I'm just trying to work out the ambition and the scale. Like some geologists, they know where they go to, and others want to carry on way past where they should. So I just wanted to kind of get clarity on that one. Okay, brilliant. Well, look, I mean, Stephen, great to speak to you again. It's been a while, and good to see how quickly kind of moving things along. Appreciate that. Let's stay in touch, and sort of as you're kind of advancing things later this year, it'd be great to speak to you again. Appreciate it.
Yeah, it's good. We've got a lot of good catalysts coming up over the next 6 months, so hopefully we get to talk again.
Good man, Stephen. Thank you very much.
Bye. Good on you. Bye.